If you're watching this and thinking everything is fine, that no crash is coming, that the American government, Wall Street, and the world's biggest tech companies have everything under control, history has a warning for you. Every major financial bubble sounded exactly the same right before it collapsed. In the spring of 1637, a single tulip bulb in Holland sold for more money than a skilled craftsman would earn in 10 years of steady work. People mortgaged their homes to buy flowers they never intended to plant. Then, in the space of about 6 weeks, the price collapsed by more than 90%, and an entire nation woke up to discover it had gone mad over a flower. Nearly 400 years later, in 2026, a single American company is worth more than the entire economic output of every country on Earth, except two, built almost entirely on a technology that, by the industry's own admission, most businesses using it still cannot point to a clear financial return from. Its name is NVIDIA, and right now, 4 of the largest technology companies on the planet are preparing to spend roughly $725 billion this year alone, chasing a future that either transforms the global economy forever or becomes the most expensive financial mistake in modern history. This is the story of the AI boom, told alongside the bubbles history has already survived, and the honest, unresolved question hanging over Silicon Valley right now: are we building the future, or are we buying tulips? Let's start with what the AI boom actually looks like in raw numbers, because the scale involved is almost difficult to process in human terms. In November of 2022, a company called OpenAI released a chatbot called ChatGPT, and within months it became one of the fastest adopted consumer technologies in history. That single product launch effectively ignited a spending race among the largest technology companies in the world, all racing to avoid being left behind in what many of their own executives now describe as the most important technological shift of their careers. By 2026, the combined annual capital spending of just 4 companies, Amazon, Microsoft, Google, and Meta, is projected to reach roughly $725 billion, up 77% from around $410 billion just the year before, according to the company's own public earnings guidance. Amazon alone is guiding toward roughly $200 billion in spending this year, most of it flowing into data centers, custom AI chips, and cloud infrastructure. Microsoft has guided toward roughly $190 billion, well above what Wall Street analysts had originally expected, with the company's own chief financial officer specifically citing rising costs for memory chips and components as part of the increase. Meta has raised its own spending guidance multiple times over the past year, now projecting somewhere between $115 and $145 billion for 2026 alone, an amount that, at its midpoint, exceeds the entire annual economic output of more than 120 individual countries. And this doesn't even include Stargate, a $500 billion infrastructure venture between OpenAI, SoftBank, and Oracle, announced specifically to build out AI data center capacity across the United States. NVIDIA, the company that manufactures the specialized computer chips nearly every one of these AI systems runs on, has become the single largest beneficiary of this entire spending wave, with its data center revenue alone hitting roughly $75 billion in a single quarter, up 92% from a year earlier. At its peak, NVIDIA's total market value crossed $5 trillion, making it, briefly, worth more than the annual gross domestic product of every nation on Earth except the United States and China. To understand why serious economists and financial regulators have started using the word bubble in connection with all of this, it helps to look at what past bubbles actually looked like while they were happening, because in every single case, the people living through them didn't believe they were living through a bubble either. Tulip mania in 1630s. Holland is often treated today as an almost comically extreme historical curiosity, but at the time it reflected something genuinely familiar. A new, exciting, scarce asset, rare tulip bulbs imported from the Ottoman Empire combined with an emerging system of buying and selling contracts for bulbs that hadn't even bloomed yet, a form of speculative trading that let ordinary people participate in a market previously reserved for wealthy collectors. Prices for the rarest bulbs eventually reached levels equivalent to the price of an entire canal-side house in Amsterdam. And when the market finally broke in February of 1637, it did so almost overnight. Buyers simply refused to show up for scheduled purchases, leaving sellers holding contracts for flowers now worth a small fraction of what they'd agreed to pay. The dot-com bubble of the late 1990s offers a comparison that maps far more directly onto today's AI boom, because it involved the exact same underlying dynamic: a genuinely transformative technology, the internet, arriving alongside wildly excessive financial speculation about how quickly and how profitably that technology would actually get monetized. Between 1995 and 2000, the technology-heavy NASDAQ index rose by roughly 400%, driven by companies that, in many well-documented cases, had never turned a profit, and in some cases had barely generated meaningful revenue at all, yet traded at valuations implying decades of future dominance. The famous example, Pets.com, spent millions of dollars on Super Bowl advertising and a beloved sock puppet mascot, while losing money on virtually every single order it shipped, and the company collapsed entirely within roughly 2 years of its founding. When the Nasdaq peaked in March of 2000, it was trading at a price-to-earnings multiple of roughly 60, meaning investors were paying $60 for every single dollar of actual annual company profit. An extraordinary bet on future growth that, for the large majority of dot-com-era companies, simply never arrived. The index lost roughly 78% of its value over the following 2.5 years, wiping out an estimated $5 trillion in market value and taking down thousands of companies that, in hindsight, had never had a viable path to profitability in the first place. The 2008 housing bubble followed a genuinely different mechanical pattern, built not on speculative technology stocks, but on the belief that home prices in America could simply never fall nationwide. A belief so deeply embedded in the financial system that banks built enormously complex, highly leveraged financial products directly on top of that single, ultimately false assumption. When home prices did begin falling in 2006 and 2007, the resulting collapse didn't just wipe out speculative wealth. It froze the global banking system entirely, triggered a genuine worldwide recession, and cost the American economy trillions of dollars in lost output over the following years. There's a fourth historical bubble worth examining closely. It gets far less attention in American classrooms than the dot-com crash or the 2008 financial crisis. Yet many economists now consider it the closest historical parallel to today's AI boom, Japan's asset price bubble of the late 1980s. Throughout the second half of that decade, Japan's economy was widely celebrated as an unstoppable industrial and technological powerhouse. American business books seriously debated whether Japanese management would soon surpass the American corporate model. Japanese stock and real estate prices climbed to extraordinary heights, fueled by easy credit, intense national confidence, and speculative buying that fed on itself. At the bubble's peak in late 1989, the land beneath Tokyo's Imperial Palace was, by some widely cited estimates, theoretically worth more than all the real estate in California. Japan's Nikkei stock index peaked at just under 39,000 points. On the final trading day of 1989, what followed was not a sudden collapse like 1929 or the dot-com crash. It became something arguably more instructive, a slow-motion unwind. The Nikkei needed more than 34 years, until early 2024, just to recover its 1989 peak. Japan entered what became known as the lost decade. Although many economists argue it lasted closer to 2 full decades. Economic growth stagnated, prices drifted downward, and banks quietly carried enormous amounts of bad debt. Instead of writing those losses off quickly, that decision slowed the country's recovery for years longer than it otherwise might have. The lesson Japan offers is different from tulip mania or the dot-com bubble. Not every bubble ends in a dramatic crash. Some simply deflate, slowly over many years, dragging an entire economy through prolonged underperformance. Because the excesses created during the boom were never fully cleared away. Instead, they remained hidden on balance sheets, delaying the pain rather than resolving it. All 4 historical episodes share the same underlying pattern: tulip mania, the dot-com bubble, the 2008 housing collapse, and Japan's lost decades. Each began with something fundamentally real. Tulips were real flowers. The internet truly transformed society. Homes had genuine value. Japan's manufacturing and technology industries were genuinely world-class, but each was combined with financing structures and investor psychology that pushed prices far beyond what the underlying fundamentals could support. Eventually, confidence broke, sometimes suddenly, sometimes painfully slowly, and prices returned toward something much closer to sustainable value. So where does today's AI boom fit into that historical pattern? What warning signs have economists, central banks, and even industry executives begun pointing to? The biggest concern centers on what analysts now call circular deals, a financing structure that has become increasingly common across the AI industry. One widely discussed example involves NVIDIA. The company agreed to invest up to $100 billion into OpenAI. OpenAI would then use much of that funding to build AI data centers, filled primarily with NVIDIA's own chips. Critics argue this creates an important question. Is the demand for AI computing genuinely organic, or is it being financially manufactured? Morningstar analyst Brian Colello has specifically highlighted this structure, arguing that when a chip supplier finances its own customers' purchases, it becomes much harder to separate real market demand from financial engineering. OpenAI has entered similar arrangements with Oracle, committing roughly $300 billion toward future data center capacity. The company has also reached major agreements with AMD, purchasing tens of billions of dollars in chips, while simultaneously becoming one of AMD's largest shareholders. OpenAI chief executive Sam Altman has publicly stated that the company could commit as much as $1.4 trillion toward AI infrastructure over the next 8 years, an almost incomprehensible figure, especially for a company that currently generates roughly $20 billion in annual revenue, and, by Altman's own public statements, does not expect to become cash flow positive for several more years. Hedge fund investor Michael Burry, known for correctly predicting the 2008 housing collapse, has publicly criticized these circular financing arrangements. He argues that actual end-user demand for many AI products remains, in his words, ridiculously small, compared with the enormous infrastructure now being built. He has also questioned who independently audits OpenAI's finances. Given the company's central role in this increasingly interconnected web of AI investment, there are additional warning signs beyond the concern over circular financing. One of the most important comes from actual business results, not future promises. A National Bureau of Economic Research study published in February 2026 surveyed companies already using AI. It found that roughly 90% reported no measurable improvement in workplace productivity or overall output, even while many of those same executives continued projecting significant productivity gains in the future. That gap between present reality and future expectation has caught economists' attention. Some compare it to the productivity paradox, a pattern where genuinely transformative technologies take much longer than expected to produce measurable economic benefits. MIT economist and Nobel Prize winner Daron Acemoglu has publicly argued that current AI capabilities are being significantly overhyped, at least relative to their proven business impact today. At the same time, he also believes meaningful productivity gains are likely to emerge over the coming decade. The concern is not necessarily that AI fails. It is that expectations may be arriving much faster than real-world returns. Warnings are no longer coming only from academic economists. The Bank of England has formally cautioned about growing risks of a global market correction, tied specifically to AI company valuations. The International Monetary Fund has issued similar concerns. Its managing director, Kristalinas Georgieva, has publicly compared today's AI valuations with the dot-com bubble of the early 2000s. Then came a moment that rattled the entire industry. In January 2025, a Chinese AI company called DeepSeek announced a model with performance reportedly comparable to leading American systems, but developed at a dramatically lower reported cost. The market's reaction was immediate. Investors suddenly questioned whether the enormous spending wave driving the AI boom was truly necessary. In a single trading day, NVIDIA temporarily lost roughly $600 billion in market value, one of the largest single-day losses in corporate history. It became a powerful reminder of how sensitive current valuations are, not only to revenue, but to changing expectations. In the months leading up to this documentary, NVIDIA's stock has already fallen substantially from its peak, erasing roughly $1 trillion in market value, even while the company continued reporting record quarterly revenue. Its valuation multiple has moved back toward levels seen before the AI boom began, evidence that investors have become far more cautious about whether today's unprecedented infrastructure spending will automatically translate into tomorrow's extraordinary profits. There's one additional risk factor, largely physical and mechanical rather than financial, that has quietly become one of the most concrete constraints on the entire AI industry. And it's worth examining closely because, unlike questions about circular financing or long-term revenue projections, this particular risk is already showing up in verifiable, measurable data today. Electricity. Training and running modern AI systems requires enormous, continuous amounts of electrical power, and the physical demands of this build-out are colliding directly with an American power grid largely built decades before anyone imagined a single data center campus consuming as much electricity as a mid-sized city. According to the International Energy Agency, global data center electricity consumption is on track to more than double by 2030, reaching a level roughly equivalent to Japan's entire annual national electricity consumption. In the United States, specifically, data centers consumed roughly 4% of the nation's total electricity in 2023, a share the Lawrence Berkeley National Laboratory and multiple industry analysts now project could rise to somewhere between 8 and 12% by the end of the decade. This is no longer a distant theoretical projection. It's already reshaping real electricity markets in real time. PJM Interconnection, the regional grid operator serving roughly 65 million people across 13 states, including Virginia, home to the largest concentration of data centers in the world, failed for the first time in its history to secure enough power supply to meet its own reliability targets in its December 2025 capacity auction, falling short by more than 6,000 megawatts. Wholesale power costs within that same grid region surged 54% year over year, and utilities across the country requested a record $31 billion in electricity rate increases in 2025 alone. Those costs in many states are being spread across all ratepayers, rather than charged directly and exclusively to the data center operators actually driving the new demand. In Virginia, specifically, one industry study modeled potential wholesale electricity cost increases of up to 57% by the end of the decade, specifically tied to data center expansion. This matters enormously for the bubble question this documentary has been asking, because it introduces a genuinely new kind of risk that didn't meaningfully exist during the dot-com era. Even if AI demand and revenue continue growing exactly as bullishly as the industry currently projects, the physical electricity needed to actually run that growth may simply not be available fast enough. Building new large-scale transmission infrastructure typically takes 4 to 8 years in the United States, a timeline that lags years behind the pace at which technology companies are trying to build new data center capacity. Some of the largest technology companies have already begun responding by moving to build or directly fund their own dedicated power generation, including natural gas plants and small nuclear reactors, specifically to bypass grid connection delays altogether. That strategy further increases the total capital these companies must deploy to keep the AI build-out on schedule, and it is simultaneously generating a growing wave of local political opposition. More than $64 billion in data center projects have already been blocked or delayed nationwide by community pushback over rising electricity bills, water usage, and noise. Having laid out the warning signs honestly, it's equally important to present the genuinely serious, bullish case for the AI boom, because dismissing it as pure speculation would be just as inaccurate as ignoring the risks. The single strongest argument in favor of the current AI cycle is that, unlike the profitless dot-com companies of 1999, the businesses driving today's AI spending are overwhelmingly, extraordinarily profitable. NVIDIA generated roughly $216 billion in revenue during its most recent fiscal year, a 65% increase from the year before, and currently trades at a price-to-earnings ratio of roughly 44. That compares to networking company Cisco's ratio of nearly 472 at the actual peak of the dot-com bubble in 2000, a dramatically more conservative valuation relative to actual current profits. Unlike the speculative dark fiber networks laid during the telecom bubble of the same era, much of which sat completely unused for years, today's AI data centers are, by most accounts, operating at extremely high utilization. NVIDIA's most advanced Blackwell chips are reportedly sold out well into 2026, suggesting genuine, immediate demand rather than purely speculative overbuilding. Big technology companies are also funding this current spending wave primarily out of their own enormous cash flow, rather than through the kind of excessive debt and speculative capital that characterized both the dot-com and housing bubbles. That gives these companies significantly more financial cushion to absorb a slower than expected return on their AI investments without facing an existential threat to their core businesses. Morgan Stanley has projected that generative AI revenue could expand from roughly $45 billion in the recent past to a potential $1 trillion market by 2028, a growth trajectory that, if it materializes even partially, would justify a meaningful portion of current infrastructure spending. And NVIDIA itself has pointed to roughly $1 trillion in confirmed AI chip demand through 2027, based on actual purchase orders and commitments from its largest customers, rather than speculative future projections. Evidence that at least a substantial portion of current demand rests on binding contracts rather than pure hope. So how do these two competing narratives, genuine warning signs and genuinely strong bullish fundamentals, actually resolve themselves? Financial analysts and economists studying this question broadly converge on 3 distinct possible future scenarios, each with real historical precedent and real supporting evidence. The first scenario is a genuine bubble burst, similar in structure to the dot-com crash. At some point in the coming years, actual AI revenue growth may fail to keep pace with the enormous compounding infrastructure, spending commitments companies have already locked themselves into. That could trigger a sharp, painful repricing across AI-related stocks, along with a wave of failed startups and neocloud providers that built capacity without securing sufficient long-term customers. It could also produce broader economic damage, given how concentrated stock market gains have become in a small handful of AI-related companies, with the so-called Magnificent Seven technology stocks now representing roughly a third of the entire S&P 500's total value. In this scenario, the circular financing deals currently binding NVIDIA, OpenAI, Oracle, and their partners together would likely be remembered much like vendor financing arrangements from the dot-com era, as the specific mechanism that concealed how fragile actual underlying demand truly was until the moment confidence finally broke. The second scenario is a meaningful correction followed by genuine, sustained long-term growth. Notably, that is exactly what happened after the dot-com crash itself. Amazon's stock fell roughly 90% during the dot-com bust, yet the underlying thesis that the internet would fundamentally transform commerce ultimately proved entirely correct over the following 2 decades. It simply took considerably longer and involved considerably more financial pain along the way than the most optimistic investors in 1999 had priced in. Under this scenario, today's AI leaders, NVIDIA, Microsoft, Google, and a handful of the strongest AI native companies would survive a painful valuation reset. Weaker, more speculative competitors and over-leveraged infrastructure providers would fail, while AI itself would still go on to reshape the global economy meaningfully, just on a longer, more grinding timeline than current stock prices currently assume, more closely resembling the aftermath of the dot-com crash than the multi-decade stagnation Japan experienced after its own bubble burst. The third scenario is sustained, continuous expansion without a major correction at all. In this scenario, AI adoption and monetization genuinely accelerate quickly enough and broadly enough across every major industry to justify current spending levels and current valuations in something closer to real time. That would allow the industry to avoid a dramatic bust entirely and instead deliver a more gradual, continuous transition, as productivity gains materialize roughly in line with what optimistic forecasts currently project. Which of these three outcomes actually happens depends on a small number of genuinely measurable, trackable variables worth watching closely in the months and years ahead. The first is whether AI revenue growth, particularly at OpenAI, Anthropic, and the major cloud providers, continues accelerating fast enough to justify the current pace of capital spending, or whether that spending growth begins meaningfully outpacing actual revenue growth. That gap would represent the clearest possible warning sign of unsustainable overbuilding. The second is whether the circular financing arrangements currently binding the industry's largest players together continue expanding, or whether investors and regulators begin demanding greater transparency and independent verification of the actual underlying demand these deals claim to represent. The third is whether AI adoption inside ordinary businesses, beyond the technology industry itself, begins showing up in verifiable, measurable productivity data, addressing the exact gap identified in the National Bureau of Economic Research's February 2026 findings, or whether the gap between AI hype and AI's actual measured business impact continues to widen. The fourth is whether the electricity and grid capacity constraints currently emerging across markets like Virginia, Wisconsin, and other data center hubs get resolved through new generation and transmission investment fast enough to keep pace with planned data center construction, or whether power availability itself becomes the hard physical ceiling that ultimately slows the entire build-out, regardless of how much capital companies are willing to spend. And the fifth is simply how markets respond to NVIDIA's own results in the coming quarters, given that NVIDIA has effectively become the single most important bellwether stock for the entire AI industry. Any sustained deceleration in its own growth would likely trigger a much broader reassessment of AI valuations across the board. So, is the AI boom of 2026 a bubble, a temporary excess destined to correct before eventually paying off, or the leading edge of a genuinely sustained economic transformation? The honest, evidence-based answer, resisting both blind optimism and reflexive doom, is that current data genuinely supports elements of all three scenarios simultaneously. And the specific historical parallel most useful for understanding this moment isn't tulip mania, where the underlying asset had essentially no lasting economic value once the speculative frenzy ended. Instead, it sits somewhere between the dot-com era, where a real transformative technology existed alongside genuinely excessive short-term speculation that ultimately resolved into durable long-term growth, and Japan's late 1980s experience, where genuine national economic strength became so thoroughly overpriced that the eventual reckoning stretched across decades rather than years. The eventual outcome ultimately depends less on whether the technology itself is real. It clearly is, and more on which specific companies, financing structures, and business models actually survive the process of separating durable value from speculative excess. It also depends on whether the physical constraints of electricity and infrastructure get resolved in years, or, as in Japan's case, in decades. History's clearest lesson across tulip mania, the dot-com crash, the 2008 housing collapse, and Japan's lost decades isn't that transformative new technologies and assets are never worth genuine excitement. Tulips remained beautiful flowers. The internet did transform the entire global economy. Homes remained genuinely valuable long-term assets, and Japan's technology and manufacturing base remained genuinely world-class throughout its decades-long stagnation. The lesson is that markets, driven by very human psychology, consistently struggle to separate an asset's real, sustainable value from the speculative premium collective enthusiasm temporarily piles on top of it. And the size and duration of the eventual correction tends to scale directly with how much leverage, how much circular financing, how many unresolved physical constraints, and how much collective certainty accumulated during the boom itself. Right now, in the summer of 2026, The world's largest technology companies are committing more capital to a single emerging technology than has arguably ever been committed to any comparable bet in economic history. It is built on a genuine, real technological breakthrough, financed increasingly through complex, interconnected deals that even some of the industry's own architects now openly acknowledge deserve serious scrutiny. And it is constrained by a physical power grid that, for all the trillions of dollars in chips and data centers being purchased, cannot simply be willed into existence any faster than transmission lines can legally and physically be built. Whether future economic students study 2026 as the year the modern economy was fundamentally rebuilt, or as the year an entire generation of investors mistook extraordinary genuine innovation for an extraordinary financial mirage, remains, as of this moment, a genuinely open question. One that only time and the next several years of actual earnings reports will be able to answer with any real certainty. If this story changed the way you think about innovation, speculation, and the thin, historically recurring line separating the two, subscribe to Economy Rewind History. Because every generation believes its own boom is different, right up until the moment history quietly reminds them it never really is.